Hey everyone, welcome back to another video. Be sure to smash that like button. And it does seem like that the Fed just responded to what exactly is happening with the recession. Now, a lot of people were worried that we're going to get a 2008 type recession, which is going to be the biggest drop in the stock market. And we're going to be seeing a huge financial crisis. But the Fed just responded and they basically said that they don't see a recession on the way. We did have some indicators when the banks started failing in 2022, but right now this is really good news that could basically help the markets right now. This is actually fantastic. We have been planning a huge recession for 2021 and 2022, but the Fed just responded that they don't see a recession coming at any point anytime soon. And this is a pretty good news overall, as we have been waiting for such updates for such a long time. All through, some people are saying that the recession could arrive early 2024. People believe that interest rates are about to trend lower as the economy deteriorates further and tips into a recession next year. What do you guys think about this? Personally, I do think Fed has a fair chance. They haven't been even thinking about cutting the interest rates. The interest rates are sky high right now, but at least it's not 10% interest rates, which would just tumble the economy. And honestly, that just the Fed responding that we are not going to be seeing any US rate hikes means that the inflation could be under control. So this is a big bonus. Now, nobody can actually predict what happens to the market like we did in 2008, but it does seem that we could be seeing more jobs. We're seeing high US debt. We're seeing the stock market not taking such a hit as the real estate market. Now, that's a completely different thing, but let me show you this clip.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
What do you guys think about this? I'll keep you updated with more news on this channel alone. Be sure to smash that like button. Until next time.